Hello and welcome to our webinar on the CGT Small Business Concessions. For those that don't know me, my name is Adrian Bailey and I'm one of the principals at Cleary Hall, working out of the Sydney office. Kate Chalker is going to take us through our presentation today. I'll introduce her shortly, but first, just a couple of housekeeping items. If you look over on the right-hand side of your screen, should be the right-hand side, there is a button or an icon which is labelled Files. If you click on that, you'll be able to download the presentation today for future reference. If you have questions, feel free to put them into the chat box. There should also be the ability for you to do that over on the right-hand side of your screen. I'll be staying on and moderating those questions for Kate, so I'll either ask her during the presentation at an appropriate time, or we will also have time at the end to go through them. At the end of the presentation or sometime later today, you will receive an email with some very quick feedback questions. We do appreciate you completing that. Pretty much all of our topics come from feedback, and this topic in particular was a request from Accountington WA. So without further ado, I'd like to introduce Kate Chalker. Kate Chalker is an associate with our practice and has been with us for some time, and she is going to tell us all we need to know about the CGT Small Business Concessions.
Thanks, Adrian, and hello, everybody. As Adrian mentioned, we are looking at the CGT Small Business Concessions today. I'm sure that whenever you have a client approach you and say, I'm thinking of selling my business or selling the shares in my company, maybe selling some business property, I'm sure one of the questions they ask is, how much money am I going to end up with in my pocket once this is all over and all taxes are accounted for? And so if we are able to meet the conditions of the small business concessions, they are a very handy tool to reduce or even eliminate the capital gain that can arise on that transaction. And the conditions can seem simple on the face of it, but there are a few technicalities and a few places where practitioners can slip up. So in today's webinar, we'll be going through each of those conditions one by one, particularly looking at the conditions for dealing with shares in a company or units in a unit trust. And then we'll also be looking at the different options or the different ways in which they can be used to reduce a capital gain. I find that the best way to understand the CGT concessions is by working through a case study. And so this is the case study that we'll be going through today. Up the top in blue, we have Trading Co. This is obviously a company which is carrying on a manufacturing business. It was established back in 2015, so it's been operating for 9 years. And over the last 12 months, the company has had a turnover of 1.4 million, and the company was recently valued at $3 million. If we look at the assets that are held within Trading Co., we have a factory where the manufacturing business is carried out, and that's worth approximately 2.2 million. We have some plant and equipment valued at 900,000. We have some different motor vehicles worth 350,000. We have some units in a property unit trust equal to 10% of the units, and the value of those is 450,000. And last but not least, we have some cash sitting in a term deposit worth $50,000. So that's the company. If we go down to the shareholder level, there's 3 individuals there. We have Peter, Wendy, and John. Peter and Wendy are married, and John is their son. On the left, Peter holds 60% of the shares on issue. He was the individual who started the business, and so he's been there since the inception. If we look at his personally held assets, he's got a share portfolio worth about $500,000, and also in his self-managed superannuation fund, he has a members balance of $700,000. If we look then at his wife, Wendy, she owns 30% of the shares in the company. She owns the property where her and Peter live. So she owns the main residence worth about 2.1 million. And she also has the same superannuation balance. Then if we look at their son, John, he owns the remaining 10% of the shares in the company. And personally, he owns a $50,000 boat. He likes to get out on the water over a weekend. And in addition, he has a healthy cash balance of 150 grand and also 70 grand in his retail super fund. So in this case study, we've got Peter, who's getting on. He's 67 years old and he's looking to retire from the business. And he thinks that it's about time for John to step up and take over. So what he's considering doing is transferring his shares in Trading Co. to John with no consideration to be paid back to him. But he is concerned that there could be tax implications for him if he were to transfer his shares to John. And so, of course, the first question that we have to consider in this case is there a potential capital gain that we need to be concerned about? And of course, the answer is yes. When we're looking at whether there is a capital gain, we need to look at what are the capital proceeds and what is the cost base of the CGT asset. And in this case, even though John's not paying anything for the shares, we know that we have the market value substitution rule, which will apply. And here we know that the company is valued at $3 million. If we multiply that by Peter's 60% shareholding interest, we have a value of approximately $1.8 million. As for the cost base, Trading Co. was just established as a shelf company back in 2015 with nominal share capital. So the capital gain which Peter will derive in his own hands will be just less than 1.8 million, but I'm just going to use that figure for convenience. So before we get into the small business CGT concessions, we should look to the discount capital gain and whether that can be applied. So the discount capital gain percentage will be either 50% if we're dealing with an individual or a trust, or it would be 33.33% if we're dealing with a complying super fund or an eligible life insurance company. And there are 4 different requirements that need to be satisfied to apply the discount capital gain. So, like I mentioned, we need to be dealing with either an individual, a trust, or a complying super fund that is the taxpayer making the capital gain. The CGT event must happen after September 1999. The CGT asset must have been acquired at least 12 months before the CGT event occurs. And lastly, we can't choose to use the indexation method. So clearly in this case, Peter is going to satisfy each of those requirements. He's an individual holding the shares and he has held them since the company was established in 2015. And obviously the capital gains tax event is happening after 1999. So we will be able to use the discount capital gain to reduce the gross capital gain from 1.8 million to $900,000. So that's a very simple way up front to halve the capital gain that would be payable by Peter. So now we can move to the small business CGT concessions. And when we're looking to apply these, there are 4 different basic conditions that have to be satisfied before we can apply any of the concessions. And these conditions are found within subdivision 152 of the 1997 Tax Act. And we need to make sure that all 4 of them are satisfied. If just one of the basic conditions is not met, then it means that none of the concessions can be applied and the taxpayer will be left with the gross capital gain or potentially half of that if they are eligible for the discount gain. So we'll go through each of these in turn. The first one is a quite simple one. It simply requires that a CGT event happens in relation to a CGT asset of the relevant entity. When we look at CGT assets, that term is given a fairly wide definition within the legislation. It includes assets such as real estate, shares, units, cryptocurrency, leases, goodwill, licenses, foreign currency, contractual rights, and that's just to name a few. So clearly the shares within Trading Co that are held by Peter would constitute a CGT asset. So then we need to consider, is there a CGT event? And the CGT event which you most commonly come across is CGT event A1, referring to the disposal of a CGT asset. And that's because Peter is giving away his shares in Trading Co to John. And last but not least, it's going to occur after September 1999, which not a problem here. And so we can easily say that the first basic condition is satisfied. Moving on to the second, this is also a fairly straightforward one. We just need to show that putting the small business concessions aside, that the CGT event would have resulted in a capital gain to the taxpayer. So going back to the calculations we did before, we just need to show that the capital proceeds exceed the cost base, and because we're looking at the market value of those shares, we would be dealing with a capital gain of 1.8 million. So the second basic condition would also be satisfied here. It gets a little bit trickier now when we move to the third basic condition. And if you read the legislation, there are actually 4 different options or 4 different ways in which this condition can be satisfied. But the 2 that you most commonly see are these 2 that I've got on the slide currently, which is that either the taxpayer is a CGT small business entity, or the net value of the assets owned by the taxpayer and their related entities do not exceed $6 million. So looking at the first option, the relevant taxpayer has to be carrying on a business, and the annual turnover of that business has to be less than $2 million. We know that Trading Co is carrying on a business and that its annual turnover is $1.4 million, but we have to remember that that's not actually the relevant taxpayer here. The relevant taxpayer that will be making the capital gain is Peter. And when we look at Peter individually, he's not carrying on a business. So there's no way that the first option can be satisfied because we simply don't have a small business entity. So then we're left to look at the second option, which we call the maximum net asset value test. And so that means that the market value of any assets owned by Peter, together with his affiliates and his connected entities, taking off any debts that are attached to those assets, the total figure there cannot exceed $6 million. And so I mentioned a couple of new terms there, affiliate and connected entity. I'll just explain what those 2 mean. So to be an affiliate is a person who acts or could reasonably be expected to act in accordance with the taxpayer's wishes or in concert with the taxpayer in the carrying on of the business. So it's a bit muddy as to whether or not a person is an affiliate. And it is a question of fact, which comes down to a few different factors that the Commissioner would consider, and none of them are decisive. But a few of the factors that might be considered are, is there a close family relationship? Are the different people involved all members of the same family group? Is there a formal agreement between the individuals, such as a shareholders agreement or a unit holders agreement, that dictates how the parties are to act in relation to each other, and what are the actual actions of the parties? If there is a close family relationship, it's more likely than not that there will be an affiliate relationship, but just because 2 people are married, for example, does not automatically make them affiliates. Again, it comes back to that question of fact and looking at all the factors together. If there is no formal agreement between the parties and the decisions are simply based on verbal discussions between the parties and the course of conduct, then that's another suggestion that there will be an affiliate relationship between the parties. So looking at this case study, we know that the relevant taxpayer is Peter. Wendy is his wife, John is his son. They all work together in the business, and it could probably be implied that they do act in accordance with Peter's wishes. I'm going to assume that there's no formal shareholders agreement. So in this case, I would think it likely that Wendy and John would be affiliates of his, which would mean that their personally held assets would need to be counted towards the $6 million test. Looking now at the second concept of connected entities. An entity will be connected with another entity where one of them controls the other, or they're both controlled in the same way by a third entity. And when I say control, when we're dealing with a company, you can demonstrate control if you hold at least 40% of the shares on issue in the company. Or if we're looking at control of a trust, you would need to look at the distributions made by the trustee over the last 4 years. And if somebody has received at least 40% of those distributions, then they would also be deemed to control the trust. So in this case, we know that Peter owns 60% of the shares in Trading Co. And so because that's over the 40% threshold, Peter would be deemed to control Trading Co. Trading Co would be a connected entity, and therefore we also need to include the assets held by Trading Co. In working out the maximum net asset value test. So if we look at the calculations here, the first line I've got is the shares in Trading Co. And that would be either because Trading Co is a connected entity of Peter, so we include the value of the business, or alternatively, we've got Wendy and John being Peter's affiliates and they own the shares in Trading Co as well. Either way, you come to the same outcome in that you need to include the $3 million value of Trading Co. Then in addition, we know that Peter has a $500,000 share portfolio. That's a CGT asset that would need to be included. Then we have the cash that John owns. Again, John is an affiliate of Peter, so we would need to include that in the calculation. And so when we add all of those assets up, we come to a total value of $3.65 million. Now, there were a few assets that were excluded from this calculation. We know that Wendy owns property, but that is her main residence, and a main residence is not counted towards this calculation, so no need to include that. You also don't include any personal use assets, so John's boat would also not be counted towards the figure. And then last but not least, the 3 superannuation balances of Peter, Wendy and John have also not been included because they are excluded under the legislation. So looking at the third basic condition, even though Peter is not a CGT small business entity because he is not carrying on a business himself, he would meet the maximum net asset value test, and so it would be satisfied. I did mention that there are actually 4 ways in which you can satisfy the third basic condition. Although these are less frequent, I will just set them out for you. The third one is where the taxpayer is a partner in a partnership that is a CGT small business entity, and the relevant CGT asset is an interest in a partnership asset. That is one way to satisfy the third basic condition. Or last but not least, it would be satisfied if the CGT asset is a passively held asset used in the business of an affiliate, connected entity, or a partnership of which the taxpayer is a partner. So, for example, if Peter owned the factory himself, so that would be a passive asset to him, but it's used in the business of a connected entity, trading co. That might be a way in which to satisfy the third basic condition. But of course, that's just an example. We know that the factory is owned by trading co. Moving now on to the fourth basic condition, which is the active asset test. And so this one requires that the CGT asset, which is the subject of the CGT event, is an active asset. What does that mean? It must be an asset used or held ready for use in carrying on the relevant business. And the asset must have been active in accordance with that definition for at least half the period of ownership. So if the asset was owned for 15 years or more, you simply need to show that it was active for 7.5 of those years. They don't need to be consecutive years. It just has to be sometime within the course of ownership. Or if the asset has been owned for less than 15 years, we just need to show that it was active for half that period. And there are some special rules when we are dealing with shares in a company or units in a unit trust. And so a share in a company will be deemed to be an active asset if the market value of the active assets of the company total at least 80% of the market value of all the assets of the company. And there are corresponding rules that apply to interest in trusts. So if we look at the calculations here and we look at which assets are active and which are not, on the left-hand side, we've got the factory that's used in carrying on the business and conducting the manufacturing. The plant and equipment also used within the business and would be active. And again, the vehicles would also be active for trading co. So adding up the market values of each of those gives us 3.45 million. On the right-hand side, we've got the inactive assets. So trading co owns some units in a property unit trust, which is not related in any way to the carrying on of the manufacturing business. And so that would not be considered to be active. Also, we have the cash that's just sitting in the term deposit account, just accruing interest. That would also be considered inactive. So if we add those two types of assets up in terms of their market values, we get $500,000. And so then we would need to divide the active component, 3.45 million, by the total market value of the assets, 3.95 million, which would give us an active percentage of 87%. And so because we're above that 80% threshold, the active asset test would be met. And now we've also satisfied all 4 of the basic conditions. However, in this case study, we are dealing with shares in a company. And when we are dealing with shares in a company or units in a unit trust, it doesn't end there. There are 4 more additional basic conditions that we have to satisfy if we are going to apply any of the concessions. And these additional conditions were modified and tightened back in February 2018. So again, we'll go through each of those. The first one is what we call the modified active asset test. And to be honest, this is quite a convoluted condition that really only applies to multi-layered structures. But essentially, what the difference is that to include any financial instruments or cash within the calculation, they would need to be connected with the business itself. And you also have to exclude the value of any shares or units held by the object entity. And under this modified active asset test, the market value of the active assets of the company and any connected cash or financial instruments has to be equal to 80% or more of the market value of all assets of the company, disregarding any shares in companies or interests in trusts that the object entity owns. So it doesn't make too much of an impact in relation to this case study. It would have been different if Trading Co. owned a greater percentage of the units in the unit trust, because then some of the assets of the unit trust would have been brought into this calculation. But because we are below that 20% threshold, we would actually exclude the value of the units in the unit trust entirely, and it would actually result in a higher active asset percentage of 98%. But the reason why this was introduced was to prevent taxpayers who were unlikely to meet the active asset test from injecting cash to try and artificially bump up the company's active asset percentage over the 80% threshold. Now, by having that qualification that the cash and the financial instruments have to be directly connected with the business, that's to try and cut off that loophole and make sure that the taxpayer really does satisfy the active asset test. Moving on to the second additional basic condition. This one says that if the taxpayer does not satisfy the maximum net asset value test, then the taxpayer must have been carrying on a business just before the CGT event. And the significance of this condition is really in the timing, because under the normal basic conditions, it just says that the taxpayer has to be a CGT small business entity in the relevant income year. So previously, if a taxpayer had worked out, okay, I've got this CGT event, but I don't think I'm going to qualify for the maximum net asset value test, I'm just going to start carrying on a business myself. My turnover is going to be less than $2 million because I'm just starting out. Then I'll be considered a CGT small business entity and I'll get to apply the concessions. What this one says is if you don't meet that maximum net asset value test, you must have been carrying on that business just before the CGT event. So there's no way to try and change your business status after the CGT event has already occurred. But in this case, it's not an issue. Peter's not carrying on a business, but we already know that he would satisfy the $6 million test. So we would be able to satisfy this condition as well. Moving on to the third additional basic condition. So this is where we move our focus to what we call the object entity. And so when we're dealing with shares in a company, the company itself would be the object entity. When we're dealing with units in a unit trust, the unit trust would be the object entity. And here, the object entity would need to be either a CGT small business entity or it would need to satisfy the maximum net asset value test. So we've previously applied these tests to Peter, but now because we are dealing with shares in a company, we also need to apply them to Trading Co. And much like the standard maximum net asset value test, we do need to look at any affiliates or connected entities of the object entity. However, the difference here is that in the previous maximum net asset value test, the control percentage was 40%. So I said that Trading Co. would be connected with Peter because Peter owns 60% of the shares. It's above the 40% threshold. But here, the control percentage is actually reduced to 20%. So if Trading Co. owns at least 20% of the shares in another company or 20% of the units in a unit trust, then the assets of that entity would be included in the calculation. So by reducing that percentage, it has a way of grouping or connecting a lot more entities. So going back to what the requirements are of the fourth basic condition, we know that Trading Co. is carrying on a business, it's running a manufacturing business, and its annual turnover was 1.4 million. We don't need to worry about the turnovers of any affiliates or connected entities because none of Peter, Wendy or John are carrying on businesses themselves. And the only other entity we have is the unit trust, but it only has a 10% unit holding. So we would already satisfy that first part of the fourth additional basic condition because Trading Co. would be a CGT small business entity. And additionally, we need to show that the taxpayer who is having the CGT event occur to them is a CGT concession stakeholder in the object entity. Or if that's not met, we need to look at all of the CGT concession stakeholders together, and all up, they have to have a small business participation percentage of at least 90%. So I've thrown out a few different terms there in terms of concession stakeholder, small business participation percentage. What that means is that only an individual can be deemed to be a CGT concession stakeholder. And to be a significant individual, you must have a small business participation percentage of at least 20% in that entity. And you get that small business participation percentage through either your voting power in a company or your rights to distributions in a trust. And you can have a direct small business participation percentage or an indirect small business participation percentage. It's all a bit convoluted, but essentially what we're looking for is who are the individuals that have an interest in this entity. So you might have some holding entities, but you work your way through those intermediate entities and see who are the individuals who are benefiting from these entities and what is their control percentage in the object entity. So here it's not too difficult to apply because we've just got Peter directly owning his shares in Trading Co. and he owns 60% of all of the shares on issue. So because he does exceed that 20% threshold, he would be a significant individual and a CGT concession stakeholder. And so that fourth basic condition would be satisfied. So happy days, we've met the four basic conditions and then also the four additional basic conditions because we are dealing with shares in a company. So now that we know that we qualify, we can then look at, okay, what are the different options that Peter will have in terms of how to deal with the $900,000 capital gain that he's left with. The first of those options is to look at the 15-year exemption, and this one is contained within subdivision 152B of the 97 Act. And if the requirements of the 15-year exemption are satisfied, it means that the entirety of the gain can be disregarded. In terms of the requirements of this exemption, there are two. The first one is that it must be an active asset held by an individual for at least 15 years. That's how the exemption gets its name. And then also the individual who's making the capital gain has to be either 55 years or older, and the CGT event which occurs has to be in connection with their retirement, or else the individual is permanently incapacitated. And in this case, we know that we can't apply the 15-year exemption for Peter because the company only came into existence in 2015, so he's only held the shares for 9 years. But potentially, if he were to delay the transfer of his shares to John, he may be able to qualify for the 15-year exemption. He's already over the age of 55, but when that happens, we would need to be able to show that the transfer of the shares was in connection with his retirement. Given that he said that he's looking to retire, I don't think that that would be difficult to establish. But right now, this option is not available to Peter because we've only had that asset holding for 9 years. Because we can't apply the 15-year exemption, we then look to the 50% small business reduction. And this one's under subdivision 152C of the 97 Act. And this 50% reduction can be applied in addition to the general 50% discount. So we've already applied the 50% discount to reduce the gain from 1.8 million to 900,000. If we're able to apply this, then that will reduce it by a further 50%. And all that you need to apply this 50% small business reduction is just to meet the basic conditions. So we've already been through all of those. We already know that Peter does meet the basic conditions, so we would be able to apply this reduction. So like I said, we had a capital gain of $900,000. In addition, we can apply the 50% small business reduction to reduce Peter's gain to $450,000. So we've already reduced the gain for Peter by 75% of what it originally was. The way to deal with the last quarter of the gain would be through the small business retirement exemption. This is under subdivision 152D. And under this exemption, the relevant taxpayer can elect to disregard all or part of a capital gain up to their lifetime limit of $500,000. And much like the last exemption, this one can be applied in addition to the discount capital gain and also the small business reduction. Now, it does vary a bit depending on the age of the taxpayer who's applying the exemption. If they are under the age of 55, then whatever they elect to disregard under this exemption, they would need to actually pay those proceeds into a complying superannuation fund. If the taxpayer, however, is over the age of 55, then there's no requirement to do that. They can just receive the funds themselves and not be required to put that money into super. If the gain is made by a company or a trust, and the trust is looking to apply the retirement exemption, it can be done. We just need to choose a significant individual to apply the exemption. So that's going back to the concept of that 20% ownership or control in the entity. There are a few other conditions that apply for the company and the trust, mainly that the company or trust has to actually pay that amount of money to that individual that's equal to the amount that they're choosing to have exempt. So if we look at this case, we've already applied the general 50% discount to reduce the gain to $900,000, and then the 50% small business reduction to reduce it again to $450,000. If here we assume that Peter hasn't used up any of his $500,000 lifetime limit, we could choose to disregard the entire balance of the gain. And because Peter, I think he's 67 years of age, he's over the 55 years of age. So there's no requirement for him to put any money into super, which is a good thing here because there's no money actually being paid to him for the shares. Alternatively, there is a way to have the spouse of the taxpayer apply the retirement exemption. So if they wanted to, they could have Wendy choose to disregard some of the capital gain under her retirement exemption. Again, that would depend on whether she had used up any of her lifetime limit. But by doing that, we can deal with the last of the capital gain. And so Peter would be able to transfer his shares in Trading Co. to John, obviously not receiving any consideration for those shares. But then by meeting the basic conditions and the additional basic conditions, Peter would be able to reduce his net capital gain to nothing, which is the perfect outcome here. So as you can see, if we are able to meet those different conditions, the concessions can be a very effective way of dealing with the sale of a business asset or even restructuring a business itself. So certainly an important thing to keep in the back of your mind and to work through when dealing with these types of situations. I finished a little bit early on the basis that there might be some questions from the people watching. So I'll hand over to you, Adrian, to see if there's any that's come through.
Yeah, there's a couple, Kate. So obviously if you have more, feel free to put them in. From Liam, is a holiday home non-income producing included in the $6 million test, as it would be a personal use asset?
I had thought that one would be included in the maximum net asset value test. Is that correct, Adrian? I didn't think there was a way of excluding that one.
It's included, or it can be included, definitely if it's not held by an individual. Where it's held by an individual is an older case of alt not. That said, it's really a matter of evidence in that you have to show that it is for personal use only and solely has been for personal use and ready for use. So I guess the short answer is it is and it isn't. It can be, depends on the circumstances. Comment from Paul: years ago, Cleary Hall had an excellent flowchart for small business CGT. Has this been updated? Is it still available? Thanks, Paul. Nice to hear from you. No, it hasn't been updated since the changes in relation to transfer of shares. So thanks for the reminder on that, Paul. We should dust that off, get that updated and circulate it to Legal Resource Club members. Another question, Kate. Did I understand correctly that the $2 million turnover test does not apply when selling the shares in a company?
Well, the turnover test in this case, the taxpayer is Peter and he's not running a business, so we don't apply it there. But it does come into consideration in the additional basic conditions in that the object entity, the trading company, would need to satisfy the $2 million turnover test. So it doesn't apply at the shareholder level, but it does, in a roundabout way, apply it at the company level.
Okay. And in terms of the small business retirement exemption, can you use the rollover if the client is not yet 55, but will be in 1 year's time to avoid depositing the funds into super?
Yeah, I believe you can. I don't think I've ever done that myself, but I've certainly heard Adrian suggest that as an option. I might defer to you on that one, Adrian.
It doesn't make it right, Kate. Yeah, so effectively what you do, because you have a 2-year window where you can use the replacement asset rollover, small business replacement asset rollover. If you don't acquire a replacement asset in that 2 years, then that's when you have the capital gain. So if it's the case that then the taxpayer is over the age of 55, you won't have to put it into super. Question from Xander, going back to your case study. Kate, is it just the remaining $450,000 in the retirement exemption that would have to go into super if he was under 55 years, or is it the entire proceeds?
Yeah, it would just be the remaining $450,000. So yeah, whatever you're electing to disregard under that exemption, which, because we've used the other concessions to deal with the other 75% of the gain, it is just the $450,000 that would need to be put into super.
Okay. And continuing on questions on the case study, if the company assets are sold and not the shares, does this change the outcome? Both shareholders are under 55.
If the company assets are sold, okay, well, the company would meet the CGT Small Business Entity test. The active asset test would be satisfied. So I would think that the company would be able to meet the basic conditions. I suppose then it's a matter of how you get those funds out of the company down to the shareholder level.
Can you elaborate on how Peter may be able to use some of Wendy's lifetime limit under the retirement exemption?
I believe it's a provision within the legislation that if you do have a significant individual within the company, that you can apply the retirement exemption to their spouse. So I think it would be open to Peter to not just apply all of the retirement exemption himself, but he could also rely on Wendy's lifetime limit.
I'm pretty sure she also has to be a shareholder as well in that circumstance. Like, she may not be a significant one, but she does have to be a shareholder. Will the recording be available? Yes, it'll be uploaded to our YouTube channel a little bit later. Toby's got a question. We've got shareholders with B-class shares holding 21 shares, which are dividend access shares. Would they be a CGT concession stakeholder?
I don't think the dividend access shares would constitute any control of that company. I think it would need to be shares with voting rights. So no, I don't think the B-class shareholders would be CGT concession stakeholders in that instance.
No, it would depend on the terms, but it's very likely, because you do, apart from voting, you have to have a right to capital as well, and they're unlikely to have that, so they wouldn't be CGT concession stakeholders. There was a school of thought for a while that if you had them on issue, you couldn't have a CGT concession stakeholder at all, even on the ordinary shares, but that's since been found not to be the case in a court matter. Would a retail shopping centre be an active asset?
I think, that all comes down to, are you carrying on a business in running that retail shopping centre, or is it just a passive asset that you're managing? I think there's definitely scope for it to be an active asset, but it would really come down to the circumstances of the taxpayer and their business.
Yeah. Remembering that there's a carve out if the asset is used or predominantly used for rental purposes only. So yeah, Kate's right. You have to show that you're actually carrying on a business by holding the retail shopping centre. Is there a maximum value which applies to the 2-year replacement asset rule?
Not quite sure on that one.
No, there's no maximum value. It just depends on you obviously meeting the concession requirements in terms of either net asset value or turnover. So that kind of limits it itself. You wouldn't be having a $50 million business using the small business concessions and rollover. If a trust has a CGT event, the majority of the income is passive income from commercial rent. In this case, the trust is not running a business and can't use the turnover test.
Sorry, I'm just reading that one again. Yeah, no, that would be right. If the trust is just deriving passive income and not carrying on a business itself, then it would need to satisfy the $6 million maximum net asset value test.
Can the company contribute the lifetime limit of $500,000 per shareholder from the company into the SMSF? So I think the question is, can you pay it directly from the company, or does it have to go to the taxpayer first?
It has to go to the taxpayer first. That's one of the conditions.
And clarifying question, you can have several classes of shares and still access CGT concessions. Yes, depending on the rights of those shares. And you have to meet the thresholds of voting control and so forth. So we'll close it off there. As mentioned in response to one of the queries, this webinar will be uploaded to YouTube at some stage. If you have any further questions that we didn't get to, we'll review all the chat. We'll reach out to you separately. But thanks, Kate, for your presentation, and thank you to everybody for tuning in.
Thanks, everyone.